welcome to Ask Jane session. It's a weekly session with me, Jane Hanlon from the Wise Mortgage Club. I've been around a few years and seen many changes to the equity release market. I've been qualified as an advisor and undertaken compliance work such as file checks and reasons why. The question we're asking today is what kind of client would benefit from the new Pure Heritage Freedom 40 range? A quick review of the product, just an overview. What makes it different is the 40% overpayment, 12 payments per calendar year, minimum of 500. You've got the fixed early redemption penalties, free valuation. Obviously, the percentage borrowed is based on the age of the youngest, minimum valuation of 70,000, minimum balance of 10,000, with a maximum cash release of 600,000 in England and 250,000 in Scotland and Wales. You've also got the added benefit of, should it be a joint application and anything happen to one, you have a 3-year window in which to redeem without penalty. It also includes sheltered and retirement accommodation within certain limits, and you can have a drawdown facility. So I think you can see it ticks all the boxes. Firstly, I'd like to ask our lender guest, Chris from Pure, to discuss the rationale and thinking behind the product from the lender's point of view.
Hi there, Jane. Thanks for the introduction into the product there, and thanks for having me on this session today to speak to all your members. I think for this product, it's really exciting, and a product that, being honest, we've been trying to bring to market for quite some time now. And I think with the advent of what's going on with the coronavirus at the minute, it made it even more important that we look to launch this product at this time. When we devised and looked at this product, everything we tried to do here at Pure is to help grow the equity release market. So we look to try and devise products that will appeal to people that maybe have overlooked equity release in the past. And I think if we go back to my career in the equity release market, it's just been under 10 years now. And when I came into this market, I think there was a perception by a lot of clients and advisors that maybe hadn't looked at equity release before, that the plans were maybe a bit of plan of last resort, and once you did equity release, you were locked in for it for life. And maybe back then that might have been the case with the high interest rates, the fairly restrictive early repayment charges. So what we've tried to do here with this plan is really open up a new section of the market for advisors and clients, and really want to appeal to clients who may need some money at this point in life, but then realise that in some point in the future, they have the ability to make substantial payments back. If we look at the majority of the plans in the market at the minute, they either offer interest repayments or flexible repayments up to 10%, and I think there's a couple of plans in the market that even go up to 12.5%. With this Pure Heritage Freedom 40 going up to 40%, it really does allow clients to make ad hoc payments to reduce that debt, because one of the biggest worries that clients have when they're looking at lifetime mortgages is how that debt accumulates over the years and the compounding effects that interest has. Here we're saying to clients and advisors that we have a plan here that means that if your client thinks that they're going to be able to make a significant payment in the future, they may receive an inheritance, they may move or downsize, they may get some life insurance policy that pays out, or that they may well even have some pensions that are triggered at a certain age point. All these life events mean that clients may well come into some money at some point, which means they want to reduce the debt and the effect of the roll-up of the interest. And offering this to the clients with no obligation as well at the same time to actually make these payments, because we understand that client circumstances may well change in the future, but having the ability to be flexible towards the client's changing circumstances in the future, I think is a real key driver for this plan.
Thank you. Yes, I see lots of opportunity, very much for short-term needs. Do you think it will be used for short-term bridging?
I think it will be used for lots of different areas, and I think with the plan only launched really recently, we're really yet to see the full feedback from the advisors. However, we think that there will be a space for clients who may just need some money. If we look at the current state of the economy at the minute, there may well be clients that are now actually need to fund, maybe to help family members, maybe because they're actually not able to work, they might be self-employed. So there's that time now where they actually might need that short-term cash, but then know that when the economy gets moving again, they're going to be able to have the significant funds to pay it back. So yeah, we're really open to your clients. They might see you and go, well, I can have a lifetime mortgage, and if they play it right, between 3 and 4 years, the whole plan is paid off. So I think there's varying reasons where clients will look to use this plan.
Yeah, I think perhaps it's an ideal opportunity, isn't it, with the virus, people finding themselves short of family short of money anyway, and they can come in and help now. We did actually look and take an advance of 100,000, and if you use the plan to its extreme of clearing the 40,000 over each year and the balance in the third year, it would actually only cost you £8,000 in interest, which we thought was to the extreme. And somebody was looking to do this by building a property and selling it within a 12-month window. And that was the case we had at the desk yesterday. Obviously, they've got to build it in the time, and it might take longer, and they might not sell it straight away. But the fact of the matter is, with a bridge, you're actually tied in for 12 months or even 24 months, and there's severe penalties if you overrun. With the likes of this product, they can obviously take it for as long as they want, and they have the choice, which I think is quite nice. We did compare it then against the 10% that most products come with, and the Freedom 40 over the 2 to 3 year period would clear it against 14 years at the same rate of 4.1 if you use the 10% rule. So
yeah, I think it's really interesting to look at that, and also because I've been asked if you compare it against the 10% as opposed to the 40%. But I think really what this plan really comes into its own is that I think that we all know that you can't plan for the future, and you don't know what your circumstances are. So I think giving this plan gives the ultimate flexibility and freedom for clients to be able to have that peace of mind and comfort and knowing that if they come into funds, or if the circumstances change, that 40% can be paid off. We hear a lot of stories in the news and the press regarding lifetime mortgages and how the debt rolls up, and Jane will have spoken to many clients and advisors over the years. And the one thing that really, when people want to use a stick to kind of beat our industry, it's about the roll-up effect. Yep. and how that impacts it. So we're going out with a clear message out to the industry, not just the equity release, but the mortgage market for financial advisors. And what we're saying here is, look, we've got this plan that really doesn't tie your clients in. It's got fixed DRCs, so it's clear and transparent.
Yep.
It's got that 40% overpayment option that can be paid at any time, meaning that if the client is really concerned about the roll-up effect of the interest, they are able to use that, and paying off 40% of the initial loan amount is really, really, really chunky, and it can help to really reduce the roll-up effect of that interest, which, as we said, is the big factor that clients and advisors look for. And I think we've really, in the few years, we've got hung up on how interest rates have fallen, and it's great news how interest rates have fallen. Probably, it's fair to say, nearly halved over the last 5 years. But what a good advisor I found is will always do is not just focus on the interest rate, but focus on the features of the plan, because the interest rate is only one consideration. And so actually, to help reduce the roll-up effect, if you look at interest rates and the options to make repayments, and looking at that together, should really open up the opportunities with this plan.
Well, I think the features are excellent, to be honest with you, and we have had a lot of inquiries at the desk regarding this product and the scope that it can help people during this period. And we've also had an instance where someone like myself that would normally retire at 60 has to wait till they're 66 now. And with other pensions and the timing of pensions at this current climate, you wouldn't want to cash any of them in. So again, it's another opportunity for the IFA advising his clients on the pension side as well. So real opportunity, really moving the products into, as you say, a bigger, wider audience, which we're really grateful at the desk, to be honest with you. I actually see it as a self-serve. Sorry?
What I was going to say, Jane, it's sometimes technology isn't our friend. So what I was going to say there, Jane, is what we're really finding, and you say we've got lots of inquiries. What we expect will happen is that this product is a great hook to start talking to your client bank about maybe people that had dismissed it in the past. And what we fully anticipate is that you'll start talking to them about this option, and then it may well be that you start talking to about other plans that are available in the marketplace. But we really think this will be a really good hook to start introducing it to different people. And then, you know, I think we all agree that one of the frustrations about this marketplace is that I don't think enough clients really understand how great lifetime mortgages can be, because we've still got this idea that the work how they did 10, 15, 20 years ago, and we're fighting hard to break down those barriers and remove that stigma, and that's coming down, and I think just plans like this will help move the industry on. And I think what's also exciting is this is a move from Pure to open up areas of the market that maybe haven't been served as well in the past. And obviously we're committed to this product, and then we'll be looking at other areas of the market that we can expand outside the traditional areas in the coming months. Later in the year, we've got some other exciting plans with products that will hopefully open up other areas to help grow this market and fulfill its potential.
That sounds excellent. Are you actually moving towards like an offset mortgage?
With this plan, it is moving to that way, and not want to say too much because I know in products things can change from time to time, but there are plans and ideas to really take this plan. This is what we hope is just the start of a suite of products that will transition and help clients use their property to the best of their ability to finance their retirement. So there are other plans on the roadmap ahead. Obviously, coronavirus has slightly put a spike in that somewhat. And as I say, I don't want to say too much because things may well change, but there are some other exciting plans that we hope to have on the runway and deliver to the advisors by the end of the year.
So can I ask why it was 40%? What was the...
I think really good question, and probably what I'll answer as best as I can. I would probably anticipate is that we wanted to get the repayment as large as possible, but also then make it attractive for us and the funder to be able to offer this product. I think if we went much higher than that, then trying to devise a product that fits the client's circumstances and also makes it commercially viable for everyone, you know, it's getting that right balance, and we felt that 40% is a good starting point, and as we may well flex and look at other options as we get more feedback on this product. And that's the thing that I would say is to all your viewers that are listening or watching this webinar, Jane, is that for plans like this, you know, this is our first attempt at it. We think it's a good first attempt, and is really unique in the marketplace. But I would ask anyone to feedback either direct to ourselves here at Pure or via the help desk to you, Jane, and then you can work with us as we receive the feedback. If there's anything that you think may well improve this product in terms of pricing or features, then we'll definitely look at that in the coming weeks and months.
Well, I certainly think it ticks most of the boxes, and we're really excited about it because it is a different marketplace. It will open up for the IFAs and the mortgage advisors. It's another thing in their toolbox, isn't it, really? Yes, well, I wish you all the best with the product. We'll obviously be taking any questions from viewers or listeners. So I thank you, Chris, for your time, and hope you will join me again next week for Ask Jane. Thank you.
No worries. And just a final thing from the Pure perspective as well. Now that we've got the automatic KFI for Pure Retirement via the Advice Wise portal, and you know, never has been a better time to be looking on the AdviceWise system, and obviously the ability to get your KFIs a lot quicker, which saves the advisors time. But also at the same time, I'm firmly of the belief that if we can cut out as much manual input as possible, no one's perfect, Jane, and if we can stop advisors having to input the client's data in as many times as possible, it will reduce the errors and help you to spend more time with your clients rather than on the admin work. So thank you very much for the support AdviceWise has given us on that.
Thank you.
And take care and be safe, Jim.